Welcome to Greatest Traders by The Complete Trader's Edge. I'm your host, and this series tells the stories of history's most extraordinary traders. Not just what they did, but how they thought, how they managed risk, and what their psychology reveals about the craft of trading. Every episode connects to the three pillars: mind, method, and money. Today, Episode 9. John Paulson, the greatest trade ever made. 2007. The United States housing market is beginning to crack. For years, the price of American homes has risen so steadily that an entire financial industry has been built on the assumption that it will never stop. Mortgages have been handed to people who cannot afford them. Those mortgages have been packaged into bonds and sold to investors around the world. Those bonds have been rated AAA by agencies that never examined the underlying loans. And the entire structure, trillions of dollars of it, is resting on one assumption: that housing prices across the entire United States will never fall at the same time. One man looked at this assumption, examined the evidence, and concluded that it was not just wrong, it was catastrophically wrong. And then he built a trade around that conclusion that would produce $15 billion in profit. The largest single-year gain in the history of financial markets. His name was John Paulson. He was not a housing expert. He was not a mortgage specialist. He was a merger arbitrage trader from New York who had spent 20 years doing something completely different. And that, as it turns out, was part of his edge. He had no institutional loyalty to the housing market. He had no career invested in the assumption that housing was safe. He looked at the data with fresh eyes, saw what the insiders could not see because they did not want to see it, and built the greatest trade in history. John Alfred Paulson was born in 1955 in Queens, New York. His family was middle class. His father was an accountant. There was nothing in his background that suggested he would become one of the most successful traders alive. He attended New York University as an undergraduate, where he studied finance, and then earned an MBA from Harvard Business School. At Harvard, he graduated as a Baker Scholar, a distinction reserved for the top 5% of the class. After business school, Paulson worked at several investment firms, including Bear Stearns, where he learned the mechanics of mergers, acquisitions, and corporate finance. In 1994, at the age of 39, he founded Paulson & Company, a hedge fund specializing in merger arbitrage. Merger arbitrage is a strategy that profits from the price gaps that exist when one company announces the acquisition of another. The target company's stock typically jumps, but trades below the offer price until the deal closes. Merger arbitrage traders buy the target, sometimes short the acquirer, and capture the spread when the deal completes. It is a conservative, low-volatility strategy, not glamorous, not headline-making. Paulson & Company performed well, but was not considered among the elite funds on Wall Street. By 2005, the fund managed approximately $4 billion. Respectable, but not remarkable in a world of $100 billion institutions. What changed everything was a man named Paolo Pellegrini. Pellegrini was an Italian-born analyst who had joined Paulson's firm after a career that included stints at several investment banks. He was 50 years old, recently divorced, and by his own description, had not achieved the level of success his education and intelligence should have produced. He was hungry, and Paulson gave him an assignment that would change both of their lives. Paulson had been growing increasingly uncomfortable with the U.S. housing market. The prices seemed disconnected from fundamentals. Mortgage lending standards had deteriorated visibly, and the financial instruments built on top of those mortgages, the mortgage-backed securities, and the collateralized debt obligations, had grown so complex that almost no one fully understood what was inside them. Paulson asked Pellegrini to do something that almost nobody else on Wall Street was doing: actually analyze the data. Pellegrini spent months building a database of U.S. housing prices going back decades. What he found was alarming. After adjusting for inflation, housing prices had deviated from their long-term trend by an unprecedented amount. The gap between where prices were and where the historical trend suggested they should be was larger than at any point in recorded history. Pellegrini calculated that housing prices would need to fall by approximately 40% nationally to return to their long-term mean. 40% nationally. At a time when the entire financial establishment believed that national housing prices had never fallen and could never fall. Pellegrini and Paulson dug deeper. They examined the actual mortgages that were being packaged into the securities that Wall Street was selling as safe investments. What they found confirmed their worst suspicions. Mortgages were being issued to borrowers with no income verification. Adjustable-rate mortgages were being offered at low teaser rates that would reset to unaffordable levels within 2 to 3 years. Loans were being made at 100% of the property value, meaning the borrower had no equity at all, and the rating agencies were giving these securities the same AAA rating as U.S. government bonds. The system was not just fragile, it was fraudulent. Not in the legal sense necessarily, though later investigations would reveal widespread misconduct. In the structural sense, the entire edifice was built on assumptions that had never been tested against reality, and that even a modest examination of the data revealed to be false. Paulson now had the thesis. The housing market was going to collapse. The mortgage-backed securities that Wall Street was selling as safe investments were going to default. The question was, how do you profit from that thesis with limited downside in a way that produces asymmetric returns? The answer was the credit default swap, or CDS. A credit default swap is, in its simplest form, an insurance policy on a bond. If the bond defaults, the CDS pays out. If the bond does not default, the buyer of the CDS loses the premium they paid. In 2006 and early 2007, the premiums on credit default swaps for mortgage-backed securities were extraordinarily cheap. The market believed these securities would never default. Therefore, the insurance against their default cost almost nothing. For Paulson, this was the perfect instrument. The cost of being wrong was the premium, which was small relative to the size of the position. The payout for being right was the full face value of the bond. The asymmetry was extraordinary. Risk 1 to make potentially 100. This was the structure that every trader in this series has described as the ideal setup. Limited, defined downside, and effectively unlimited upside. Paulson launched 2 dedicated funds specifically to execute this trade. He called them the Paulson Credit Opportunity Funds. He raised approximately $700 million from investors, many of whom were skeptical, but willing to allocate a small portion of their portfolios to what they saw as an interesting hedge. Most of Wall Street thought Paulson was wasting his money. Through 2006 and into early 2007, the housing market continued to hold up. Paulson's CDS positions were losing money every month in the form of premium payments. The trade was not working. His investors grew nervous. Some asked to withdraw their capital. His own team questioned the thesis. The psychological pressure of paying premiums month after month on a trade that everyone in the market said was wrong was immense. This is the part of the story that matters most for every trader listening to this. The greatest trade ever made did not feel like the greatest trade while it was being constructed. It felt like a mistake. It felt like burning money. The premiums were real. The losses were visible. And the consensus of the entire financial industry was that Paulson was wrong. He held. He held because the analysis was sound. He held because Pellegrini's data was irrefutable. He held because the structure of the trade meant that even if he was wrong for another year, the cost was manageable. And he held because he understood something that separates great traders from everyone else. Being right early is almost indistinguishable from being wrong. The market can stay irrational longer than you might expect. But if your thesis is built on structural reality rather than opinion, eventually the structure wins. In the second half of 2007, the housing market broke. Subprime mortgage defaults began accelerating. The securities that had been rated AAA began to lose value. And then they collapsed. The credit default swaps that Paulson had purchased for pennies began paying out at par. The positions that had been losing money for over a year suddenly became the most profitable trades in financial history. By the end of 2007, the Paulson Credit Opportunity Funds had returned approximately 590%. 590% in a single year. The total profit was approximately $15 billion. Paulson's personal share was estimated at between $3 and $4 billion. It was the largest single-year income ever recorded on Wall Street. The scale of the profit is difficult to comprehend. $15 billion is more than the annual GDP of many countries. It exceeded the total profits of some of the largest banks in the world. It was earned by a fund that most of Wall Street had never heard of, managed by a man who had spent 20 years doing merger arbitrage, based on research conducted by an analyst who was starting over at 50. But the story does not end with the profits, because what happened after the trade reveals something important about the difference between a single great trade and a sustained great career. In the years following the subprime trade, Paulson made several large investments that lost significant money. He bought heavily into gold, which declined. He invested in pharmaceutical companies, including Valeant, which collapsed under scandal. He made a substantial bet on a Greek bank recovery that did not materialize. His fund lost billions in the years following the greatest trade. This is not unusual. History is full of traders who made one extraordinary trade and then struggled to replicate it. The psychological dynamics are particularly challenging. After making $15 billion, every subsequent trade feels small. The standards for what constitutes a good opportunity become distorted. The confidence that comes from being right on such a spectacular scale can shade into overconfidence on trades where the edge is smaller. And the public attention that follows a legendary trade creates pressure that did not exist before. Paulson's post-trade struggles do not diminish the achievement. They illuminate it. The subprime trade was not the product of luck or a single insight. It was the product of months of rigorous research, a structurally asymmetric instrument, disciplined position sizing, and the psychological resilience to hold through an extended period of losses while the market told him he was wrong. The subsequent difficulties remind us that even the greatest trade in history does not guarantee future performance. The market demands humility, and it extracts that humility from everyone eventually. Let us map the legacy of John Paulson to the 3 pillars. Paulson's method on the subprime trade was fundamentally research-driven. He did not use technical analysis. He did not trade charts. He examined the actual data behind the financial instruments that Wall Street was selling as safe investments, and he concluded that the data did not support the prices. His method was, look at the evidence that nobody else is examining, reach an independent conclusion, and find the instrument that expresses that conclusion with the best risk-reward characteristics. This approach, driven by deep research and independent thinking, rather than by charts or market sentiment, connects directly to the lesson of every great macro trader in this series. The CDS structure was the key to the entire trade. By using credit default swaps, Rather than shorting stocks or bonds directly, Paulson created a position where his maximum loss was defined and small, while his maximum gain was virtually unlimited. This is the purest expression of asymmetric money management in the series. He risked the premiums. He stood to gain the full value of the underlying bonds. The ratio of risk to reward was not 1 to 2 or 1 to 5. It was 1 to 100. When you find that kind of asymmetry, and you have the research to support the thesis, the sizing conversation changes entirely. The months of paying premiums while the market moved against him tested Paulson's psychology in a way that few trades ever test a trader. He was right. But the market did not agree yet. His investors were questioning the trade. His peers were dismissing it. His own team had doubts. The ability to maintain conviction through that period, to continue paying the premiums, to resist the pressure to reduce the position, required a psychological strength that cannot be taught in a textbook. It can only be developed through experience, self-knowledge, and a deep trust in one's own analytical process. It is not about whether you are right or wrong. It is about how much you make when you are right, and how much you lose when you are wrong. George Soros said that. But it might as well have been written about John Paulson's subprime trade. The entire architecture of the position was designed around that principle. The cost of being wrong was small. The reward for being right was historic. And the willingness to sit through the uncomfortable middle, the period where the trade looked wrong, but the thesis was still intact, was the psychological variable that turned a good idea into $15 billion. If Livermore taught us that knowing the rules is not enough, if Soros taught us that conviction must be matched with size, if Jones taught us that defense wins, if Seykota taught us that the system is never the problem, if Dennis and the Turtles taught us that psychology determines who succeeds with the same rules, if Darvas taught us that independence beats information, if Druckenmiller taught us that concentration beats diversification, and if Buffett taught us that patience is the ultimate edge, then John Paulson teaches us the final and perhaps most dramatic lesson of all, that the greatest trades are not the ones that feel great while you are in them. They are the ones that feel terrible. They are the ones where the market tells you that you are wrong, where your investors doubt you, where the premiums are bleeding your account, and where the only thing keeping you in the trade is the knowledge that your research is sound and your structure is asymmetric. The greatest trade ever made was not a moment of triumph. It was months of endurance, followed by a moment of vindication. The edge is not in the conviction alone. It is in the structure that allows you to hold that conviction through the pain. John Paulson built that structure, and it produced the greatest trade in the history of financial markets. You have been listening to Greatest Traders by The Complete Trader's Edge. This episode was based on Chapter 68 of the book, The Complete Trader's Edge, by Lou Von Riet. Available now on Amazon in Kindle, paperback, and full-color editions. For the full article on John Paulson, trading guides, and free resources, visit CompleteTradersEdge.com. If this episode resonated with you, subscribe wherever you listen to podcasts and leave a review. It helps more traders find us. Next episode, the final chapter in this series, we tell the story of the man who did not trade, but taught an entire generation of traders how to think. Mark Douglas. See you then.